Welcome to the Commercial Real Estate Podcast powered by First National. I'm Aaron Cameron, and with me, of course, Adam Płatek, recording live here at RealCapital. I'd like to thank KingSet for sponsoring our speaker video series as part of the RealCapital Forums. Our guest today is Hanna, who's the managing partner of investments at Crown Realty Partners. Welcome, Emily.
Thank you.
So, you did it. Don't worry, you did it. We're going to jump right in, Emily, and just start with your background, how you got into real estate, how did you end up at Crown, what's your career look like?
Okay. I got into real estate through the rather circuitous route. I did my PhD in economics. And when
For fun.
As one does.
That's the long route. Real estate, you can go high school to real estate if you really want.
You don't even need high school.
Well, anyways, I needed a little bit of encouragement, I guess. I was finishing up my PhD, had no interest in academia, was interviewing mostly with management consultancies, and they would ask, what areas of interest do you have? And I said, the industries of interest are oil and gas, telecom, fiber optics, railways. Why? Because of the value of the underlying real estate assets. At a certain point, I shifted my interviews and meetings and was like, well, not sure how often developers actually approach the McKinseys, Bains, and BCGs of the world. Let's start talking to them. So I reached out to a number of different people out there, leaders out there who were very gracious with their time, met with me, and I told them about my story and learned about their stories. And one of those individuals was Michael Emery, who had started Allied REIT and is the president, or was the president of Allied REIT at the time. And he introduced me to a couple more people, talked about the industry, his evolution in the industry, and said, to get a really good, broad understanding, why don't you meet with someone else? So we sort of ended up meeting with his partner prior at the time, Wayne Jacobs, very different personality to Michael's, and continued to network that way. And at a certain point, I had a couple of job offers. Something just didn't feel right. I wanted to do something in the real estate space. Maybe it was something in the blood, I don't know, but I just really wanted to do it. I left one of my meetings with Michael and said, one day I'm going to do what you do. And had a couple of job offers, and did my graphic design maneuverings, took Allied letterhead off of online, posted it, and said, if this was a job ad that you sent me, I may consider it. And Michael said, come on in, let's talk. And we did. And at the end of it, we came up with the very descriptive title of associate, and had no idea what I would do.
I love it. I love the graphic design element of putting it all together.
That's yeah. I'm known for my marketing prowess and graphic design skills in the office right now.
So he has been in the podcast before, so you are partially doing what he's doing, so you were correct that you'd end up doing what he does one day.
Partially, yeah.
How long did you stay at it as an associate?
So I jumped a lot from there. I was hungry. Like when they initially brought me on, they were like, look, you've got some quantitative skills. Obviously, we don't know how that's going to translate in the real estate industry. And you have a bit of chutzpah, a little bit of qualitative skills too. We don't mind hanging around you. We think you'd get along great. So let's see how this fits in. And how it initially fit was sort of me working around. At the time, the principals were all involved hands-on in the business, doing everything directly. And the idea to have somebody there who was hungry, willing to take on more, and stay up till all hours of the day and night to work on things. I just had the opportunity to take on more, progress, and almost write a career path. So I did leap fairly quickly throughout, and my career evolved as I was willing to make a business case for something. Provided I didn't screw up and it made logical sense, they were willing to let me go at it.
And all the while learning the ropes of the office industry.
Directly through phenomenal leaders. So working directly with the CFO, working on public equity markets and capital raises and bought deals, and who was there? it's 2 a.m., but hello, I'm here, ready to talk.
And what era was this? When, just do time frames, so
What
just
era?
so people can. Well, I just like, you look young, so like, is this like last year, 2 years ago? Like, what?
Exactly. I was moved very quickly.
Yeah, I was gonna say.
I think '08. Oh no, wait. When did I finish? Probably '08, '09. I mean, it was like 20 years ago.
Okay, so as Office was still picking up speed, I mean, especially the stuff that Allied was doing,
It
like they
was the stuff-
reinvented, really reinvented sort of the office
I
market
was on
in
a
downtown
phenomenal-
Toronto.
I had the opportunity to get exposure to this phenomenal growth curve. The value proposition of Allied at the time, as it started to grow, was fully built on, being the value proposition space. Not only is it cool and clean and compelling and nice to occupy, but it also happened to be cheaper than occupying any other space, and that was what caused the portfolio to grow. Not to get too nerdy, but like part of my knowledge of that portfolio and my interest actually tied to my empirical economics background, where there was municipal zoning policy change that effectively said anything west of Spadina or east of Jarvis, that's your do anything regenerative zone. And that was what caused this phenomenal growth in the Allied portfolio. And that was what attracted my attention to that portfolio and to the whole story, and just the concept of the REIT, which when it's in favor is a fantastic source of capital.
Was it a REIT when you joined?
It was a REIT. Yeah, it had just sort of shifted.
But they were still on this incredible
On the
acquisition growth side, right?
So I had the chance to be part of that phenomenal growth, of identifying intensification opportunities within the portfolio, working with brilliant people like Michael and Dermot Sweeney of Sweeney & Co. to sort of and the lawyers and zoning folks to see there is value in this portfolio. Now, nobody was willing to pay for the residential value at that time, much like now, but there was a significant amount of value that required a unique mindset and a little bit of a different approach.
Just for anyone that's listening that's maybe not from Toronto, because I know there's lots of listeners and you aren't familiar, outside of the downtown core, if you're picturing Toronto, there's all these giant office towers. If you immediately go anywhere east or west of there's a whole bunch of older 5-story, 6-story sort of brick, old manufacturing buildings.
Part of the garment trade, similar type of assets in many of the urban markets,
right,
that you'll see just outside east or west of the financial core.
And it feels like when you're walking around those neighborhoods, Allied owns half of them and has purchased them and converted them to these beautiful sort of exposed brick and beam style office buildings.
It's important to mention, not knocked down and built.
Yes.
Very, very unique office space. Very attractive. I mean, which maybe was part of for the longest time, call it through the 80s and 90s in Toronto, there was the University Street barriers. That would be from Toronto, from the western edge of what you call the traditional office core here, and people didn't want to go past that line for a long time.
For the first development that we worked on, 134 Peter, the whole team and I met at Union Station, and this was before Google Maps could do this. We each took a different route, and it was like walk to Queen and Peter, cycle to Queen and Peter, take the subway car, show that it's not that bad to get there.
And it's not, for the record.
And that was the same thing with many of the retail investors within the portfolio, the lenders. Let's show you what's there. There's
you had to sell the vision at the
And
time.
Yeah, and it really was, this development that kicked off with a number of the parking lots along University, the Ritz Hotel, this like proliferation of top tier hotels and other assets that brought a bit more attention to University, and then started shifting people a little bit west.
What do you think in your mind is the new boundary that people don't want to go across? How far out are we downtown-wise?
Oh boy, what's the new boundary?
Well, the tech center, there's this sort of, I don't know what the word is, disassociation with the downtown core, right? Like a decoupling of the core. You can basically go anywhere, can't you?
I was going to say, so now it's not become, before the boundary was, I'm too cool to be in the core. Now, do you know what? If I can afford the core, I'm going to be there, and I can wear my hoodies and have my beer tap and have some good coffee that they steal the coffee shops from the junction and bring them up here and put them in any of the office towers. So I think it's shifting, and it's becoming more about what is the value proposition of the space that you're going to occupy.
So before we go there, let's finish your career trajectory.
Oh.
We got to Crown. I don't want to know about Crown still.
Yes.
So you Allied at some point. There was a good the opportunity to move on. So
yes. So, and it's funny. My kind of career started going in has been going in these spiraling circles. So the last transaction I worked on when I was at Allied was a well-known carrier hotel, 151 Front Street, the one that has recently been part of a portfolio that's recently transacted, and through that acquisition, what became very clear to me was the value in the infrastructure within the buildings that we own. Initially, my interest in infrastructure was the value of the underlying real estate. Now I'm coming back to, there's an interesting value in the infrastructure there. That building, that beast is based on the power, the cooling, the fiber that runs through it, and that has a huge amount of value. And having the opportunity to think in a slightly different way. As I said, REITs are phenomenal when the market is open and when you're in favor. It's also possibly a pleasantly suffocating model, and the idea of shifting to private equity was something that was intriguing. I wanted to be flexible. I wanted the ability to jump across different asset classes. I wanted the ability to dive in deeper and maybe think more on data centers or other infrastructure, and I thought that there was that opportunity and believe that there is that opportunity at Crown. And so came into Crown, and Crown had recognized the need to establish a succession plan early on, the original founders, and I was part of that plan, and like the idea of being a bit of a generalist, which you can do when you're part of a smaller platform and part of a private equity shop, as opposed to, now being the Emily that was able to jump around and make a business case for something in leasing, for something in operations, for something in acquisitions. That became no longer possible with the massive growth that happened and the organizational structure that was required.
You get laned. You get put into a lane and stay in your lane.
I did not want to be in a lane, and I sort of like veering anytime I drive. I get the little tick, 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 tick vibration that happens, and I'm like, I go past it and through it.
And I got to imagine you do not miss quarterly reporting either. That's inherent in the REIT structure.
So you can't avoid that. And so that was my initial thrill, I guess, at the private shop. And ultimately what Crown is, we raise capital and invest on behalf of primarily institutional investors. And because we're private equity, we put money alongside and have skin in the game. But because of the nature of our investors, because of the professionalization of the level of sort of professionalism that's required in that, it means that we have to report on a quarterly basis, and we track to frameworks that are important and make sense. And in fact, none of these fiduciaries who choose to work with us would do that if we didn't pass muster when it came to these extremely detailed due diligence questionnaires that we have to fill out.
So is it fund management, or are they direct investments? How does that work?
So we have a bit of both. We are the bulk of our assets under management. They're sort of split between our funds that have committed pools of capital, primarily closed-end value-add funds in the commercial real estate sector, and the other part is a little bit of third-party management, actually, on behalf of some of our LPs and relationships that we hold close. Some are through special purpose vehicles that we asset manage as well.
Right. And those closed-end funds, one, just maybe talk about the size and how many and the purpose.
Sure. We started, so Crown has been around for just under 25 years. We started just syndicating individual deals. Early on in the 2000s. A few years later, got enough of a track record, had some relationships, and started raising funds. 2006 was our first fund, committed capital of around $60 million. 3 years later, raised the next fund, committed a little bit more. Fast forward to our most recent fund, Fund 5, which is our largest to date, $260 million of committed capital from primarily institutional investors.
And you say commercial, that's office?
That does include office, and that is the primary mandate. That has been through and through. We have been value add, and we have identified different ways of adding value in our assets from beginning to end to generate
and Toronto specific.
We have an operating team and an operating platform in Toronto. We expanded to Ottawa and also do the same thing in Ottawa. That's part of our core.
Was the security the steady Eddie of Ottawa? Was that the siren call that got you out there?
There was a little bit of that. Initially, actually, our assets didn't actually have any government tenancies, but really as a value add player and as a group who ultimately has to think about the exit, and even when we look at stable assets, we always consider the exit. And when you have to do that, you think of what are the markets that are the most liquid.
I just like saying VECTOM, and it's just,
yes.
Have you heard VECTOM,
Yes,
right?
yes.
It's like, and so that Ottawa's in there, right?
Are you going to
Ottawa's
state
in
for
there.
the audience what it is?
Vancouver, Edmonton, Calgary, Toronto, Ottawa, Montreal, and sometimes Halifax.
And sometimes it's like the vowel
Silent H.
Y, and
and
sometimes
Y, exactly.
No, so those Toronto, where we had a platform, Ottawa, where we established a platform and got a certain level of comfort around there, and a lot of the transactions too do get managed through Toronto. Those ones.
So has anything
Ottawa.
interesting been happening in the office market recently?
Yeah.
There's a few headlines.
Well, where do you want to go with that? I mean, you tell me. We've talked about it a lot early on in the COVID world, and quite frankly, and our regular listeners would know this. We haven't really covered this in a while because I think we just got sick of talking about it. Everyone and their grandma has an opinion on what's
Indeed.
transpiring in
On
the
return to office
on return to
specifically,
office and how it's impacting it. But you're living it, so maybe just talk about the impact it's had, if you can, in a nutshell, and then where we are today and what you're seeing going forward.
Sure. Benjamin Tull and Paul and John had a good summary of sort of just the market. There is no one story to tell about the office market, that's for sure. It's bifurcated, it's very nuanced, and there are specifics. The reality is we are doing deals within our portfolio. We're also one of the top tier managers. We also focus on value add, which gives you a lot of room to play. So the nature of value add has just evolved significantly. What businesses want out of their office space has evolved, and we have had to be very fast at adapting to that. 10 years ago, the concept of model suites was like, that was our thing. We were doing it. That was our differentiator. Now, what's become the differentiator? I believe creating office assets into top-tier office assets, and one of those main things that's going to differentiate is the ability of the building to keep up with the demands, the ESG demands of the building occupants who have all put forward net zero goals and are all looking to somebody else to figure out how to do that.
It's the problem solving you were talking about, of course, is where you step in, right?
Yes.
Yeah.
So
and that's where the infrastructure comes
So
in.
explain the ESG goals, meaning that it's got to be sort of a net zero building using.
Yeah, I'm not talking about honeybees and kale on the roof. I'm talking about
Like geothermal energy.
intelligent upgrades that will transition from fossil fuel options to other options that are lower GHG.
And what are trends? I would call it prop tech that's sort of here or almost here that you think is going to have a major impact
For
on
older builds specifically,
Yeah.
right? That's the kind of the bigger challenge, of course, is trying to do this to retrofits, right?
Yes, and not all buildings can be retrofit, and it is costly. But for well-maintained buildings that have sort of been kept up to a standard and in which you need to now invest, this is the time to make the intelligent investments. When you have the buildings captive to make those investments, that is the time to do it. And I believe we have them captive when we're buying them on behalf of a value add fund.
Will tenants pay more for that?
So in a market like today, unlikely. But empirical evidence does suggest that in other markets that have been more advanced in terms of their CO2 regulations and that sort of thing, the empirical evidence suggests that they can garner a higher return. And so will tenants pay more? Not sure now, but will they look to you and say, what are your ESG objectives for the building? And if I'm a CEO or a CFO of a company and that company has stakeholders and I have made public announcements and file an ESG report for those stakeholders saying we are going to be net zero, and we're going to do that through our direct operations, through our indirect operations, and through the space we own and occupy. And that is where it comes down to our industry to figure it out. They're not going to want to pay for carbon credits. They're not going to want to pay just to brush it under the table. They're going to pay for the upgrades that will save them money, achieve their goals, and save them operating costs in the future.
So at a building level, you will see the returns come back through improved vacancy rates then, at the very least.
This is what we hope we
This is
will
the
see. I
thesis,
mean,
yeah.
I believe that many of the attributes of when the folks at CBRE talk about, there's the bifurcation and this shift, we're seeing the top performing buildings achieve and get the renewals and maintain their rates. What makes a top performing building a top performing building? This is one of the
biggest ones.
the
Well, you
features,
mentioned the bifurcation, so maybe let's just go back down to the fundamentals a little bit. And I'll put some words in your mouth. The sort of AAA core assets are performing adequately. It seems like everything else is falling off. Is that fair, or maybe correct me if I'm wrong?
I would say some of the poorer quality buildings that where you would measure quality, not just in terms of the usual things, but in terms of their ability to achieve different ESG objectives, in terms of their proximity to the core or to transit. Those are the ones that are falling off. The ones that haven't been maintained and managed well, the ones that don't have professional management that's staying on top of things, the ones that are perhaps just checkbox items.
I'm gonna go ahead, Adam.
So what happens to those, though, in a 20-year time horizon? They don't keep up with this. They don't do this. They don't see a value-add player like you come in. Like, what happens to them over a 20-year time horizon for a building that just kind of wants to tread water?
To coast?
Yeah.
Well, what's interesting is we do have energy wastewater reporting mandates. All buildings over, I believe, 20,000 square feet have to report on their GHG emissions. And there's a huge number of buildings that don't comply with the pathway that has been determined for net zero. Those are considered stranded buildings. There was a great presentation that Paul Morisuti did this morning on that topic. And those buildings that are stranded are at a certain point going to be way too costly to upgrade. And, well, those buildings are in need of significant retrofit and repositioning.
I'm going to say some things as a lender, as a general lender, not First National, but just a general lender, and then you correct me where I'm wrong. Part of the challenge we have, and I'm an ignorant, I'm as lenders, we like to say we're generalists in everything and experts in nothing. So I only know the first 1% of what there is to know about the office space. Our challenge lending on office is, one, I got to do a 25-year AM, so I have to be comfortable in the asset for 25 years. So that you just spoke to, there's a time horizon period for a lot of office buildings to end. So that creates a lot of risk for me. Two, because of the work from home, working hybrid environment that has not been solved by any stretch of the imagination, and I'll use as an anecdote First National, we're in the office 3 days a week, so we're using our space 2/3 of the time we used to. I think our decision makers at First National still having a hard time paying 2018 prices for the space that we now are using, a third less often, right? And so you think, okay, well, there's now a decrease in rents. What that decrease in rents will be is a challenge. And then, of course, you have valuations, right? And where the cap rates are that, what things are worth. So I've got challenge with whether it's going to exist in a certain period of time. I have no idea where rents are actually going to stabilize. I mean, I remember pre-COVID, we were talking about spec office builds and they were achieving $70, $80 per square foot rents. I don't know where it looks today, even for the brand new stuff. And then on top of that, I don't know what it's worth because I don't know if it is a 6 cap, an 8 cap, a 10 cap at the end of the day. So as a lender, I'm looking at this going, one, if you can even convince me to lend on it, it's a 50% loan to value. It's a high spread. It's a really unattractive investment because there's so much uncertainty. Where am I wrong with that assessment?
Through the uncertainty, there's opportunity.
Yeah.
There's a lot of headwinds for sure hitting the market, and that is where the operations are key. The value add mindset is key because even though you're in 3 days a week, are you going to...
I need the space, all 5, because I don't know, right?
Are you going to share your desk with somebody else? Do you need half a desk when you're in the space? Groups are rationalizing their space.
Yeah.
But the space that they're going to choose to occupy is the space that attracts their people into the office, makes them feel like they're valued, and also aligns with many of their goals and philosophies.
Are you seeing tenants sort of downsize and retrofit just to totally reinvent the space that they're in?
We're seeing the gamut. People just buying time. That's sort of shifted. People reducing, rationalizing their space. People upgrading to better uses, better locations. Yeah.
So you are picking off some of those buildings that we describe them as coasting, I guess. You are seeing the benefit there for well-run assets.
Yes. And at the end of the day, look, it goes back to what the Allied value proposition was. That space off the core ended up being the value proposition. For an overall occupancy cost, you could be in cheaper than the CAMs at a core building. Same thing with a well-maintained, well-managed asset that has been upgraded along the way, and where the manager has made intelligent upgrades along the way to ensure that the building is self-sufficient and moving forward and will continue to be a resilient investment. It will also be occupiable and pleasant to be in. You're not going to be in third-rate space just because you're not in one of the new buildings, because we can't build enough new buildings that are carbon zero. In fact, a bunch of the buildings that we have aren't actually net zero, that are new buildings that have been brought into the market. So, if I'm looking for that kind of space, the value proposition that I get is locating in a well-managed office building that has maintained itself and has kept up with all of the requirements.
I want to ask about buying and selling. We had a call with Emily before we started recording, and she wanted to make it clear that they were not in the market buying now, that they never stopped buying, that this was a clear plan that had been in place for many years. So you're out in the market looking at assets, buying assets. I know you closed on one recently, I saw in Twitter, I believe. Then also, I guess the counterpart to that question is, are you exiting any positions now? Because value add typically has that as part of the structure.
It's part of the ongoing structure in our funds. We do have the flexibility in those funds to extend the lifetime where it doesn't make sense and where the market isn't open. In some cases we are, and in some cases with other assets we are just we're looking at some of the assets that may be more commodity space and saying this is the right time to exit, and sort of making the call to exit versus hang on. And then there are other assets too for which, when you can't necessarily just add value internally, you look to add value outside and look for intensification potential, which we have a number of assets that have that capacity where there is zoning approval for residential in conjunction with the office assets that will transition sites into mixed-use sites, which is a very compelling investment proposition for institutional investors and others.
We are unfortunately running out of time. I got to ask, I have one last question. We've had a number of sort of office investment management companies on before, and they've brought up a trend in the U.S., which we typically trail by 10 years. So I'm curious what your thoughts are on this. And it's experiential office. And so we've heard stories. We have one, I think it's Blair Hutchison of Alpine. I'm sorry, I'm not going to remember the company. Do you know who I'm talking about?
Is it
Calgary.
The folks in Calgary?
Yeah. Where, I mean, he was on talking about, basketball courts in the front, in the lobbies, and how they would put in their second floor is a whole work sharing environment where only if you're a tenant do you have access to it, and all sorts of stuff as a tenant attraction. As you talked about, you want your employees to want to work there.
Yeah.
What's your approach to that, or what's your opinion?
And there's more also. If I end up moving to a higher quality building and leasing less space, that means I don't have space for meeting rooms. I don't have space for other things. So I look to the building to provide those services. There is an amenitization and experientialization of our office buildings. We're always trying to engage the entire community beyond.
It's an ROI. It's an ROI challenge, right?
It has to make sense ultimately from a financial perspective.
Yeah, and that I think I can see this real challenge, like a tenant saying, okay, well, I'm not comfortable with the amount I'm paying for my space because I'm already not using all of it. I want to downside. Like First National is the best example. We have a packed office building a couple times a week, and then we have an empty office building. So I need the space for those couple of days where there's 98% of our staff are in, and then the rest of the time I don't need the space. And it's really challenging as a tenant to figure out what my approach is to tenancy.
Look,
right?
I think as we're shifting, and as we've shifted to a different economy right now as well, the balance of power is shifting significantly. Everyone is focusing on operations and doing what they do the best that they possibly can. That means bringing people together to work together in their space. And it means if I haven't seen you lately, you're kind of out of sight, out of mind. And this was, one of the topics of discussion at the breakfast earlier today. And in a time of dislocation, that's a time that you want to focus and hunker down on your business and what you do, and do it the best that you possibly can. I believe that that's what all of the businesses within our portfolio are doing, and we can see it. It's palpable in the occupancy across our buildings. It's more than 2 days a week. And as the banks are shifting too, it's happening. It's beyond 2-3 days a week. It is shifting to.
Yeah, I can tell you by general sense of traffic, it's getting busier out there every morning and every evening. Last question: are you having fun doing this?
I love doing what I do. I love learning new things. I think the entire ESG journey that I've gone through has been a massive learning curve in my career, and certainly in many other people's careers, is trying to turn this thing that's seen as a cost into a true value proposition. That's what I like doing.
We didn't mention it before, and we kind of just jumped right into the ESG conversation, but I guess the context is office buildings are one of the worst emitters of carbon, like in all industries across the world. Like It's one of the worst uses of real estate as far as contributing to carbon.
If we are to take action and really affect the energy transition and reduce GHG emissions, the space that we occupy and build and own is an important thing. It happens to be that when you reposition an asset, you're probably doing the most you can for the environment in terms of embodied carbon and keeping sort of effectively recycling the building.
Yeah, as long as you don't tear it down.
As long as you don't tear it down, that does have the biggest environmental impact. Now, where it came, yes, office buildings are the biggest emitters, but also, there's the legislation. And that was like in the capital raising process for our last fund. It went without question that we had the track record. It went without question that we were top tier operators. That was not the issue. The issue was how were we going to achieve the net zero goals of our stakeholders? And we needed to have an intelligent story to that when it came to how it applied to our business.
Great. I'm happy to hear that.
Yeah.
That's I mean, that language. Adam and I have been doing this now, 6-7 years, and ESG was unknown, and now it is just table stakes. It's awesome.
It's table stakes, but it's quantifiable.
It's no longer something you say and put a policy in your document, right?
It is so clear when you see the groups that are just greenwashing. Those will be the ones that put the ESG agenda at the bottom of the barrel when it comes to things. They will not invest in their buildings as they should, and those are the buildings that will suffer as a result.
Well, financially specifically, that's the next big wave to come, is the financial performance difference between those assets that have an ESG platform and those that just greenwash and second replace it.
So any tenant who has put out a net zero goal, which most people who have stakeholders or raise capital of some sort have, any lender, because all of the banks are signed on to net zero banking initiatives, the government, where policy comes and goes, that can always shift, but large, massive institutions have all made these commitments, and those are embedded in their psyche now. To shift in the opposite direction is with different policy is going to be complicated. And so while there is no lender who would necessarily look at this asset in the future, there too will be no buyer who will look at this asset and bring it into their portfolio once they're ready to adjust their allocations and realize that office as a necessary food group in the asset classes, once they're ready to readjust and buy top tier assets, because that's what these institutions want to focus on, it is those buildings that have been repositioned and can meet all of their objectives that are going to be the ones that win at the end of the day.
The bifurcation in the market.
There you go.
Emily, we are out of time. Of course, I want to thank the Real Estate Forums for hosting us here today at RealCapital. I want to thank KingSett for sponsoring our video speaker series, First National for powering the podcast. Most importantly, our guest, of course, Emily, thanks for sharing your knowledge today.
Thank you, guys. That was fun.
Thanks, Emily.
Thanks.